Honestly, I've been scratching my head about this year. It feels like I'm in an alternate universe sometimes. You look at the stock market and a company that hasn't had any earnings is rising over 1,000% for no apparent reason. You have people buying digital media, digital video clips for hundreds of thousands of dollars. And then there's social media websites where anybody, regardless of their education or knowledge, can post stock tips and give investment advice. So when we're trying to make sense out of nonsense, we can actually pinpoint a few things that might be fueling this speculative nature in investors. First of all is this just staggering amount of money that's flowing in the system right now because of the additional fiscal stimulus we've had after COVID. Combine that with investing is basically available to anybody with a mobile device now. This has increased the amount of investors out there. You also have record low interest rates. You have frothy valuations in the equity market. So people are looking for that next hot thing. And that brings me to an important part of this conversation, and an important reason behind this speculative behavior is that fear of missing out. So when you see things on social media or you hear about it at a cocktail party and everybody's talking about these trendy items, there are people that just are afraid to be the last one in. There's really 5 distinct characteristics of a bubble that you can identify. The first one is displacement. That's getting excited about the next new thing, the next new technology. Think about the dot-com bubble when everybody had to buy anything with a .com at the end of it. Compare this now to what's going on into the cryptocurrency market, where there's a new coin being generated every single day. There is the expansion phase. Then there's the euphoria phase, the crisis phase, and what gets really dangerous is the contagion phase. And that's when these misguided investments that people have run up for no fundamental reason end up crashing and filtering into the broad market. The short answer is no. Do not confuse these products for traditional alternative investments. When we think of traditional alternative investments, this is private equity, this is commodities, these are real assets. These are products with tangible value where you can fundamentally analyze these products. When you look at things like the meme stock frenzy, where you're seeing companies that have no earnings rise just because of a social media following, that's not fundamentally analyzing a product. Look at the cryptocurrency market. This has no store of value. It's not regulated yet. And there's no way to fundamentally value it except what someone else is willing to pay. That is not going to displace the US dollar. Take non-fungible tokens, for example, where people think owning a digital piece of art or media is the new real asset. But in the end, this isn't truly owned by you. While you might own the rights to that piece of art or video, the internet really owns this. So anybody could go in and actually copy this. Versus if you invested in a piece of art or a piece of real estate. This has something that has tangible value. It is an actual product. All of these products that we've mentioned just don't qualify to be part of a long-term asset allocation. The risk alone is way too high to put into any kind of metrics in an asset allocation model. Look at the volatility. The chance of timing these perfectly when you see such daily violent swings in these products is nearly impossible. They don't check the box on what we consider as being investments that have underlying value, low correlations, diversification benefits. These just do not fall into those categories for a well-diversified long-term asset allocation. Anyone interested in buying these products just should be prepared that they may lose their entire investment. And we've seen a huge influx of activity in the markets this year. And a lot of this has to do with just the inflow of new investors that we've seen. And that's a good thing. That's a great thing for the investment markets. But just be aware that there is a dangerous learning curve as a new investor. Just because there's speculative bubbles popping up and excitement around specific names doesn't mean that anyone can abandon the real fundamental principles around investing. Some of the most important things are due diligence, patience, diversification, and fundamental analysis. These things are key to having good long-term success in investing. I'm Megan Horniman, Director of Portfolio Strategy. I encourage you to take a look at the in-depth white paper about these topics. And as always, if you have any questions at all, please feel free to reach out to your financial advisor.